A company just lost $10 billion in a single quarter, and Wall Street called it a win. That company is Oracle. It is building data centers for OpenAI, Nvidia, and Meta. It is spending $50 billion this year, and it is borrowing money faster than any tech company in decades to do it. And by the end of this case file, I am going to show you the 3 numbers that tell you whether any company, not just Oracle, is walking into this trap. Numbers you can check yourself for free in under 5 minutes. But first, you need to understand how the trap works. You check the numbers, you see the growth, you see the contracts, you see the vision, then you check the cash, and it is gone. $10 billion in a single quarter spent before it arrived. You ask what happened, they say it is an investment. The cash will come later, but when is later? But next year, they spend more, the projects expand, the customers need more capacity, and the cash keeps flowing out. This is not a mistake. This is a trap. The company cannot stop spending without admitting the model does not work, and it cannot keep spending without borrowing more money. So it does both. It spends, it borrows, it promises, and it grows. Until someone asks the question nobody wants to answer. What happens when the money runs out? That is why this case file is open. The story Wall Street tells is clean. It sounds like this. A company burns cash because it is building something big. The spending today creates revenue tomorrow. And once the build-out is done, the cash flows will turn positive. This is an investment cycle, not a crisis. Oracle's latest quarter looked incredible on paper. Revenue up 14%. Cloud infrastructure up 66%, GPU revenue up 177%, and a $523 billion backlog. Then you look at the other number, GPU-related revenue grew 177%, and the company announced $523 billion in remaining performance obligations. That backlog includes major commitments from Meta, Nvidia, and the Stargate project, Oracle's joint infrastructure deal with OpenAI and SoftBank. Larry Ellison, Oracle's founder and chief technology officer, told investors the company is committed to chip neutrality. Safra Catz, Oracle's chief executive officer, emphasized confidence in converting backlog to revenue. On paper, this looks like unstoppable growth. Then you look at the other number. Free cash flow was negative $10 billion in that quarter. Capital expenditures were $12 billion, and the company generated about $2 billion in operating cash flow. But the spending consumed it all, and then some. Oracle's own CFO calls it investment in revenue-generating equipment. That framing makes the negative cash flow sound temporary, the spending sounds smart, the borrowing sounds strategic. That framing makes the negative cash flow sound temporary. It makes the spending sound smart. It makes the borrowing sound strategic. But here is what that framing does not say, and this is the part that should make you uncomfortable. What happens if the spending never stops? Because we have seen this movie before, and the ending was not pretty. In the late 1990s, telecom companies spent hundreds of billions building fiber optic networks. The spending was investment, the demand was coming, and the future was digital. Then the dot-com crash happened, demand did not materialize at the pace they expected, companies like WorldCom, Global Crossing, and Lucent went bankrupt or collapsed, and the fiber sat in the ground, unused. In the 2010s, companies like Uber and WeWork burned cash to capture markets. The spending was investment, the growth was real, and the scale was coming. Then the money got expensive. Investors asked when the cash would arrive. Uber cut workers, and WeWork imploded. The pattern is the same. Spend to grow, grow to spend, borrow to fill the gap, and hope the revenue catches up before the debt does. One poster on a finance forum put it simply: high-growth startups are in a race to dominate their market, and then they can milk the profits for years to come. But if they do not dominate, they run the danger of becoming an also-ran. The problem is not spending. The problem is what happens when the race never ends. The moment most people miss is not the spending itself. It is the shift in where the money comes from. Oracle did not always borrow this much. The 5 major hyperscalers, Amazon, Microsoft, Google, Meta, and Oracle, historically funded their data centers with internal cash flow. They made money and they reinvested it. But something changed. According to Bank of America, hyperscalers would have to spend 94% of operating cash flow to pay for their AI build-outs. That number was 76% in 2024. The gap between spending and cash generation is widening. When spending exceeds cash flow, companies borrow, and they are borrowing at a pace that has not been seen in decades. A December 2025 report from MUFG noted that hyperscalers raised roughly $108 billion in new debt in 2025 alone. Over $90 billion of that came in the final 3 months of the year. For context, that is almost as much as all hyperscaler debt issuance from 2020 to 2024 combined. Oracle's credit default swap spreads, which measure how much it costs to insure against Oracle defaulting on its debt, tripled between September and December 2025. Oracle currently holds a BBB credit rating from S&P, which is investment grade but just 2 notches above junk status. CoreWeave, another AI infrastructure company, has shown similar credit default swap dynamics, with spreads widening as investors question the sustainability of debt-funded AI buildouts. This is the quiet turning point. The company is still growing, the revenue is still rising, but the cost of funding that growth is becoming visible in places only the bond market watches. The mechanism here is simple. It is not fraud. It is not mismanagement. It is how the math works. A company builds a data center. The data center costs money up front. The revenue comes later, spread over years. If the company is growing, it starts building the next data center before the first one is paid off, then the next, and then the next. Each new project requires more capital. The capital comes from debt, and the debt requires interest payments. The interest payments consume cash, so the company borrows more to cover the gap. This works when interest rates are low and investors are patient. It breaks when rates rise or confidence drops. Oracle raised its capital expenditure guidance from $35 billion to $50 billion for fiscal 2026. The Stargate project alone involves tens of billions in infrastructure commitments. Some analysts estimated the company might need to raise $100 billion over the next few years to complete its build-out. Oracle's financial officer pushed back on that number, saying they expect to need substantially less, but even substantially less than $100 billion is still a lot. According to Barclays, Oracle could face cash shortfalls by late 2026 if the current trajectory continues. That does not mean Oracle will fail. It means the company's growth is now structurally dependent on capital markets remaining open and friendly. Now, here is where most people would stop this analysis. They would say, this is an Oracle problem or a tech problem, but what I am about to show you proves it is neither, because the same trap is eating a company in a completely different industry, oil and gas. And when you see how the pattern matches, it changes how you think about every stock you own. Kosmos Energy is an oil and gas company. In June 2025, S&P Global Ratings downgraded Kosmos from B to CCC+. The reason was liquidity pressure and refinancing risk due to upcoming debt maturities and tight cash flow. In January 2026, S&P downgraded Kosmos again, this time to CCC. The agency cited increased likelihood of debt restructuring and estimated Kosmos could breach its debt service coverage ratio in early 2026 unless it secures additional waivers from lenders. This is a company in a completely different industry. Oil, not tech. Physical assets, not cloud capacity. But the underlying problem is the same. Growth required capital. Capital required debt. Debt required cash flow, and cash flow did not arrive. Kosmos management tried to pivot according to their proxy statement filed with the SEC. The company claimed 2024 marks the end of a capital-intensive period and said they were now prioritizing the generation of free cash flow. But the same document also disclosed that the company did not deliver positive free cash flow, citing production shortfalls and capex overspent. When a company says it is exiting a capital-intensive period and then fails to generate cash, the market notices. That is what a downgrade is the market noticing. Here is where it gets interesting. The incentives are not as simple as they look. Oracle's 2025 proxy statement, filed with the SEC, shows that annual cash bonuses for key executives are based solely on growth in non-GAAP operating income, not revenue, but operating income. The same document shows that the compensation committee determined not to pay these bonuses and reduce them to zero, stating the funds could be better directed to capital expenditures supporting future growth. That is not executives looting the company. That is a governance choice about capital allocation. Kosmos shows a similar pattern. Their proxy statement discloses that executive bonus KPIs explicitly include free cash flow and EBITDAX. Free cash flow is literally written into the bonus structure, And yet the company still did not deliver positive free cash flow. The proxy says they failed to achieve the FCF target due to production shortfalls and project delays. So the incentive story is not as clean as growth at any cost. The incentives sometimes include cash flow. The problem is that incentives do not always determine outcomes, and sometimes the projects just do not work as planned. The drift happens slowly, and nobody notices until it is too late. In the first phase, the spending is exciting, Wall Street rewards growth, stock prices rise, executives give interviews about their vision. In the second phase, the spending becomes expected. Every quarter, the company announces more investment, and growth is priced in. In the third phase, the spending becomes necessary. The company cannot slow down without triggering concern, so they keep spending. In the fourth phase, the spending becomes dependent. Cash flow cannot cover it, and debt markets must remain open. Before I show you what this means for your money, I want to hear from you. Drop a comment below. Which phase do you think Oracle is in right now? Phase 2, 3, or 4? And if you are watching a different company, go through this same drift, name it. I read every comment on these case files. MUFG Credit Strategist noted that Oracle's 5-year credit default swap had more than tripled since September, while trading volumes surged well above prior norms. The market has become more concerned about the magnitude of the company's highly debt-funded, extremely capital-intensive AI build-out strategy. This is drift in action. The strategy did not change, the math did. For the regular person, this matters more than it seems. So, what does this mean for you specifically? If you have a 401k or an index fund, you almost certainly own these companies. You are lending them money. And if rates rise or growth slows, those holdings can drop fast. If you work at Oracle, Amazon, Microsoft, Google, or Meta, your job does not just depend on your performance. It depends on the bond market staying open. One funding crunch could mean layoffs before your next performance review. And if you are a customer locked into a 5-year Oracle Cloud contract, you are betting that the company survives long enough to deliver what it promised. This is not abstract. This is your retirement account, your paycheck, and your business infrastructure. JP Morgan estimates that the build-out of data centers will require $1.5 trillion in investment-grade bonds over the next 5 years. Bank of America calculates that hyperscalers borrowed $75 billion in just the last 2 months of 2025 to fund AI spending. This is not a single company problem. This is a structural feature of how AI infrastructure is being financed. The point of no return is not a single event. It is a threshold. It arrives when the company can no longer fund itself from operations, when every new project requires external capital, when slowing down would trigger the very crisis the company is trying to avoid. Oracle's share price dropped 12% the day after its Q2 2026 earnings. Despite beating earnings estimates, analysts cut price targets. The concern was not profitability, the concern was the funding gap. Remember, at the start of this case file, I told you there are 3 numbers you can check yourself. Here they are. Number 1, free cash flow versus capital expenditures. Pull up any company's quarterly earnings. If CapEx consistently exceeds operating cash flow, that company is funding its growth with debt. You can also check the debt to EBITDA ratio. It tells you how many years of earnings it would take to pay off all the debt. Both of these are free on any financial data site. Number 2, credit default swap spreads. This is what it costs to insure a company's debt. When that cost goes up, the bond market is telling you something, the stock market is not. Oracle's CDS tripled in 3 months. CoreWeave has shown the same pattern. You can track these through financial news or services like Bloomberg. Number 3, the federal funds rate and high-yield credit spreads. These are tracked publicly by the Federal Reserve Bank of St. Louis. Completely free. When rates rise or spreads widen, every company that depends on borrowing gets squeezed. You do not need to predict what will happen. You just need to watch these 3 numbers. They will tell you before the headlines do. When it costs more to insure a company's debt, the market is pricing in higher risk. Oracle's CDS tripled in 3 months. CoreWeave has shown similar patterns. That tells you something about how the bond market views AI infrastructure debt. Third, watch the federal funds rate and high-yield credit spreads. These are tracked publicly by the Federal Reserve Bank of St. Louis. When rates rise or spreads widen, companies that depend on borrowing face higher costs. You do not need to know what will happen. You just need to know what to watch. This file is not claiming that Oracle will fail or that Cosmos will default. That would be a prediction, and predictions are guesses. This file is isolating a mechanism. When revenue-generating expansion spending overwhelms operating cash flow, the company's growth becomes structurally dependent on capital markets. That dependency is not visible in revenue numbers, it is not visible in contract backlogs, it is only visible in cash flow statements and debt issuance. Oracle insists it will maintain its investment-grade BBB rating. Maybe it will, but the bond market is pricing in doubt. The pattern is not finished, the companies are still spending, the debt is still rising, and the cash flow is still negative. If the investments pay off and revenue scales faster than debt, the trap springs open, the companies win, the skeptics look foolish. If the investments lag and rates stay high, the trap closes, the companies restructure, the believers look foolish. We do not know which happens, nobody does, but we can measure the distance between the promise and the cash. That gap is the case.